best in radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
And welcome. You are listening to the Financial Survival Network. It's Kerry, Lutz. And what's going on with these commodity markets? How do you make money in them? How do you just not lose money in them? Well, we've got Jason Burack with us now, Wall Street for mainstreet.com. Jason, how are you?
Pretty good, Kerry. I'm glad to be back and just kind of recovering. Was up in Toronto for most of this week, meeting Eric Sprott in person and Rick Roll. That was a lot of fun at a Sprott event.
Yeah, I'll bet. So, hey, you wanted to talk about what's going on with Brent crude and, hey, for WTI for that matter, below $100 and seems to be going lower. And, you know, what do you think is the rationale behind it, or what do you think's really going on?
Sure. Well, first let me lay out supply and demand, and then I'll talk about the manipulation case. BP does extensive analysis. They have their statistical review, and they do that every year, and they release that, and it's normally more accurate than the IEA or the EIA's numbers that come out, and those are the government bureaucratic agencies' numbers for oil supply and demand. What BP said was, in spite of the shale oil boom, and the U.S. is really the only major oil producer that's been increasing oil production significantly. Canada has increased it a little bit. There's a couple other countries increasing a little bit, but there's also a lot of global oil producers that have had huge declines in oil production. But basically, BP said that global demand is rising faster than global supply. Okay, so that's the supply-demand scenario we're looking at in spite of the shale boom here in the U.S., which, you know, the shale boom is an amazing entrepreneurial story. We both read The Frackers. It's really a must-read book for people out there that, you know, in spite of the rules, regulations, taxes, and things, the free market just figures out, and entrepreneurs with the profit incentive, how to, you know, solve problems and create value and profits and things like that. But anyways, though, I laid out the supply-demand case for oil. Now, we have this. We have the dollar strengthening here, which I think is kind of arbitrary, because the dollar index itself is a humongously flawed measure. It's against the euro, mostly against the euro and the yen, and that isn't even the majority of world trade anymore. There's just so much more encompassing of the G20 and the BRICS in global trade now, so measuring the dollar against mostly just the euro and the yen is ridiculous. Although, you know, recently with the ECB doing their version of quantitative easing and pulling garbage assets off bank balance sheets and printing euro and giving it to the banks to make them look more solvent than they really are, because they're extraordinarily levered. And then the yen was pretty strong for a while this year, surprisingly. At the beginning of the year, I thought the yen would, I made in my predictions for this year, I thought the yen would be below 115 by the end of 2014. And earlier in the year, I was looking very stupid. It went up to, I think it went from like 103, 104 up to 101. And then finally it started to crater. And Kerry, in only 2 or 3 months, it's back. It broke key support levels at 103 and 105, and now it's at 109. And it looks like it's accelerating more, dropping even faster, which means more stagflation for Japan, higher food and energy prices in Japan. But in terms of the oil market, Kerry, in spite of a strong dollar, in spite of the supply-demand fundamentals, it looks to me like the oil market is being manipulated here by the U.S. government, by the Wall Street and derivatives market, as part of a strategy. And let me lay out historical evidence that this would not be the first time that this has happened. There's a documentary out there called Houston, We Have a Problem. I think your listeners should go watch the documentary. There were a lot of oil industry executives in the documentary who retired, who worked during the 70s and 80s, talking about how the Soviet Union, obviously communism and socialism, it's a flawed economic model, right? But they kept the thing going for a lot longer than people thought. But the U.S. finally came up with a strategy to put the nail in the coffin for the Soviets, and that was when the oil price went from $10 a barrel in the early 70s, I think, up at one point to around $30 a barrel. It tripled. And during that time, with OPEC, with the Saudis, the Soviets took on massive amounts of debt to increase oil production. And the U.S. saw that as an opportunity to basically wipe out the Soviet Union with the debt that they had taken on by knocking the oil price back down enormously. So that the documentary, Houston, We Have a Problem, interviews oil executives who were told by people in the Reagan administration and stuff like that that was what was happening and that they were going to struggle financially, but the Soviets had to be beaten that way. And there's also other books out called The Oil Card and other books that your listeners could look up on the internet that document this. So I think this is another page out of that playbook where ISIS has the oil in Iraq, I think in the northern part, and this is meant to hurt ISIS, the amount of money that ISIS is making off the oil that they've confiscated, the oil fields. They haven't gotten the southern ones, which are the majority part of Iraq's oil production. And then also, I think this is meant, the lower oil prices are mostly, and this is the largest reason, are mostly meant to punish Russia, Saudi Arabia, OPEC, the other countries who are major oil producers who are doing these bilateral trade agreements and trying to get out of the dollar. So that's, in my opinion, what I think. And the reason for that, Kerry, is normally Saudi Arabia and Russia, they're fairly lower cost producers. The Saudis still have some oil fields that they can produce oil at $10, $20, $30 a barrel. Now, these fields are in decline. They're declining pretty large. They're in permanent decline, regardless of how much capital the Saudis reinvest into them. And the Saudis are bringing on more oil production to replace some of that is higher cost. But the Saudis, and to keep their political regime is not well liked there. It's a royal family. It's kind of oppressive, rules and regulations and things like that, and the way they treat some of their citizens like women and things. But what they have done to keep a lot of the people from full out revolting is, for many decades, the Saudis have given back a lot of those oil profits for social programs and schools and education and infrastructure and subsidies and welfare payments and things like that to keep some of the people happy. And the Russians, after the Soviet Union collapsed, have done pretty much the same thing. And both of these entities, now the Saudis are lower cost producers. The Saudi, we wrote an oil report in 2012 called the Petro Profits Report, and we cited a number of studies talking about what price these countries need the oil price at to pay off their social program bills and campaign promises and things like that. And I think the U.S. government and Wall Street is well aware of these studies, and I think that's what's being done behind the scenes to put the pressure on these countries for doing these bilateral trade agreements out of the dollar and, accepting yuan or a basket of currencies for things for their oil instead of just the petrodollar.
And don't forget, the U.S.'s production has gone up 3 million barrels per day in just the past couple of years, 2.5 years. And there's no reason to think that it's not going to go up a similar amount in the next few years. I mean, we haven't really hit the peak yet of U.S. production. So, there's a lot of slack. And there's roughly 4% of world production that is off the market right now due to various wars going on in the world, right?
Yeah.
In the Middle East. So imagine if that production was on the market, how much further the price would go down. So I think the argument you're making is plausible. I'm not sure if it's definite. I don't think we have any means of proving it. But more importantly, there is nothing we can point to disprove it. And I think the price, declining in the face of increased demand and constricted supply, at least in the U.S., you can make the argument the economy is going down, demand is going down. Cars being sold today more efficient than the cars they're replacing. So you could make an argument that price should be going down. Rest of the world, not so certain of that. And, and you've got production continuing to increase here in the U.S. for the foreseeable future, at least for the next 3 to 5 years, right?
Yeah, but the thing is, though, Kerry, and I mentioned this earlier, is that the U.S. is really one of the only major oil producers in the world that's increasing production. All the other ones, the oil in a lot of cases is owned by national oil companies, and they're struggling to increase production. There's humongous decline in production for many of these countries. The North Sea, really, in the last 8 to 10 years, the North Sea production has declined by, I think, like 8% per year. It's been an enormous decline rate. The Saudis are declining production, I think, at 3 to 4% per year. There's pretty big decline rate. Iraq was increasing production a lot, and then, the ISIS stuff happened, and there's problems with whether or not, I think Kurdistan's going to get... It's Kurdistan. It's Kurdistan. That's the other region there in Iraq. I think the other region, whether they're going to get independence, and ExxonMobil was involved in trying to help them get independence and things like that. So the U.S. is really the lone beacon carrying the torch of actually really increasing the production in an enormous amount globally. Canada has increased it a little bit, but that's much higher cost oil in terms of their oil sands. So a lot of the production increases are higher cost. What I would also counter to say is that OPEC is now announcing that they're going to do production cuts. cuts. So they're well aware, that they have to balance their budget. And if the oil price goes much lower, your listeners are going to expect to see OPEC come out and announce pretty big production cuts, because they have to have higher oil prices to balance their government budgets for spending. So I think this weakness in the oil price, I don't know how much longer it'll be in the short term, but I think it's a good long-term opportunity for your listeners. We're looking for those dividend-paying oil stocks, those pipeline companies, those master limited partnerships. Some of those have had a nice little pullback here, and they're really good opportunities for yield. They're much better than bonds in terms of the yield. And the best thing about oil and gas is it's consumed. So it's not like it can be recycled or anything like that. And, I like a product over the long term where you can make the product itself is consumed and it has to be reordered and reused and things like that. So I think there's a lot of good value now in the oil patch, whether it's in certain types of shale plays, maybe on this pullback, or also there's a lot of really good values in Canadian oil producers and oil producers outside the U.S.
Yeah, for sure. And hold back in price, nothing wrong with that. And there's additional areas in the U.S. that are being opened up now, especially in Oklahoma. So yeah, this thing has a good long ways to play. And the MLPs also are a tax advantaged, tax deferred investment that puts out cash flow. If they don't do it every month, they do it quarterly. So a lot of good advantages there that you need to take a look at. Hey, up next, we're going to talk about miners, gold and silver prices, what's next for them on the Financial Survival Network.
FSN Radio. It's all about what's next.
Every week the show is growing. Would you like to be a part of it? Then go to clubfsn.com and help support us with $1, $2, $5, or $10 a month and get a host of premium content with newsletters dropped into your mailbox, free books, private audio clips, webinars, and much more. Then join clubfsn.com. If you want to get ahead of the trend and ensure your family's financial security before it's too late, go to clubfsn.com and sign up.
The Financial Survival Network. It's all about what's next.
And if you're just joining us, we've got Jason Burack, wallstreetformainstreet.com, with us now on the Financial Survival Network. And Jason, hey, to put it charitably, gold and silver prices, it's been slaughter, to say the least. So what's going on there? Don't tell me it's all manipulation. That's certainly part of the story. It always is, but there's more to it than that, isn't there?
Well, what I would say is let's talk about supply-demand fundamentals. When I see the numbers from Coos Janssen of In Gold We Trust, and I see that, and I'll pull up Coos Janssen's website real quick, India's June gold import highest in 12 months. The Chinese gold demand, we've had multiple weeks the last few weeks where it's 39, 40 ounces per week. Tons per week of gold demand. Year-to-date gold demand for the Shanghai Gold Exchange is 1,290 tons, according to Coos Janssen, who I think does probably the best research of anyone tracking physical gold demand out of China, and his research on physical gold and silver demand in India is strong. India's silver demand has exploded enormously thanks to the increasing prices on the black market, and they didn't take off the tariff taxes for import duties on gold in India. Their silver demand, I think, is up. I think it's now almost 18% of the total silver market. It's an enormous amount of silver demand coming out of India. The Shanghai Gold Exchange, the silver in the warehouse, Kerry, is now down more than 90% in the last 12 months. There's enormous physical silver demand, whether that's for investors in China or its factories buying on the Shanghai Gold Exchange and taking delivery so they can put it into solar panels or electronics. So I don't see the situation here, supply-demand fundamentals, to justify this. I think what has happened, and maybe this, I don't know if you can call it manipulation or what, it's these high-frequency trading algo programs that are programmed to say that strong dollar means sell gold and silver and miners. So in the short term, that has helped what happened. So yes, there's painting of the charts for manipulation. Obviously, we've seen the zero hedge stories come out and say that central banks are trading, they're getting discounts from the Chicago Mercantile Exchange to trade futures, in the most illiquid hours and things like that. So there's proof about that too now. even in the Chicago Mercantile Exchange's annual reports and things like that, it talks about central banks trading futures, which is very disturbing to me. I don't know how you feel about that.
Yeah.
But yeah, I think it's just that, the stock market has been doing so good. There's been a lot of people sentiment-wise that were holding gold and silver. There's been a lot of people that have physically, emotionally, mentally just given up. These were not people that bought into the story like you and me that understand Austrian school economics. These were people that maybe they were buying the dip and they had seen the chart in the past. They had done well in gold and silver and they were trying to buy the dip, expecting it to go back. And that's just not the environment we have right now. We may have a spike low in the short term over the next couple months where gold may go retest 1180 soon and then maybe even go below that. But I think what's going to happen, and after talking with Eric Sprott in person at length about this when I was up in Toronto, and he sits on the board of directors for a lot of miners. He's a very good investor. He's had a really rough last couple of years. But if you go back and look through his long-term track record, Eric Sprott, and he's one of my role models. I really enjoy his work. He predicted the technology bubble. He shorted. He made a lot of money doing that. He predicted the real estate bubble, the banks, GM, all having problems. He shorted those. His long-term he was one of the top hedge fund managers on the planet. His long-term track record speaks for itself. And he was talking about how nothing just in the markets right now just makes sense in terms of whether it's the general stock market going up, the real estate market going up, the bond market all going up at once. You have collectibles, antiques, art, all these things are going up a lot. And in gold and silver, it seems like are the only asset class where they're just getting dumped. And maybe it's because the people who are really rich know it's manipulated and they just don't want to deal with it. I don't know. But I can tell you, though, that none of this is sustainable for more than another 12 to 18 months. I've been saying that for a little while. But the miners have gotten, I don't even know if it's sustainable for another 18 months at this point. But the miners got some debt and some equity over the last 12 months. It was at very penalty rates. The penalty rates are so high now that miners can't afford it, and it's just more rope to hang themselves with. The capital is not available to a lot of these higher cost miners unless the banks themselves are willing to give, basically subsidy loans to the miners to where the miners will deliver the metal and the banks will let them live for a while longer to meet the bank's obligation for metal. But when you have a market, Kerry, where the most efficient, lowest cost producers have multiple mines, so Pan American Silver, First Majestic Silver are probably the two most efficient silver producers in the entire planet, other than maybe Fresnillo in Mexico. And these guys have mines that are not profitable, and they haven't been profitable, some of them for a while, but now they're extremely unprofitable, and they're burning through cash in their balance sheet. So we're at a scenario where either the mines are going to be put on care and maintenance, the smaller miners who are higher cost are just going to give up and sell out for pennies to the larger miners who can maybe turn the mines around and run them at a better profit, or there's going to be 10, 20% of all primary gold and silver miners going bankrupt in the next 12 months or so. Yeah,
which if things don't turn around shortly, I think there's a certain inevitability to that, don't you?
Yeah, I agree. And long term, Kerry, I mean, this eventually, despite manipulation and painting charts and things like this, and I'm sure people don't want to hear me saying this, especially if you've bought miners or you've bought physical metal for price appreciation, that in the long term, this is healthy. So eventually, the market has to get back to some type of reality for supply and demand. It can't be a scenario where, whether it's manipulation or whatever other reasons, or these high-frequency trading programs deciding that, the dollar index looks strong today, so I'm going to short gold and silver and the miners, infinitely. It cannot last permanently. At some point, the producers of the commodity have to be able to make some kind of profit off of it. It's not sustainable. Can't tell you exactly when it'll happen, but there is now enormous opportunities for people out there who have cash and are patient and willing to wait a couple years and add to proper positions. There are good gold and silver companies out there that are being trashed and thrown out like the bad ones are that may go bankrupt. So it's a stock picker's market, and if you know what you're doing, or you're subscribed to the right newsletter, or you hire the right consultant or things like that, you can go in there and buy a company with no debt or good cash on the balance sheet and get a lot of upside in there for very little valuation there and a humongous amount of optionality there. And you could potentially, I think in 3 to 5 years, there's going to be a lot of a couple 100% companies that are coming out of this, but there's probably some more downside just because of the chart and sentiment. Like I said, the sentiment levels I think are below 3% bullish for fund managers, and these guys control a lot of capital, so they might even be selling some of their gold and silver miners now or shorting them, unfortunately.
Yeah, it's definitely a mess, which is why I've always felt you're better off owning the physical, and the miners. It's always a risk. Because you think they can't go any lower. And then what happens? They surprise you and they go lower, right?
Yeah. And from talking with miners, Kerry, talking about the manipulation, like off the record, like having a couple beers, they'll admit that this market just doesn't act the way it should. So they'll admit manipulation, act the way it should. But the problem is these guys are carrying so much debt from banks that they can't talk about it in public and do interviews. So your listeners may wonder why the miners don't comment about the manipulation or things like that. There's a couple CEOs once in a while, like Keith Neumeyer, who will talk about it once in a while, but of First Majestic Silver, but there's really not many of them who are brave enough to come out and speak about it. But the bottom line is there needs to be probably a new model for the miners to figure out how to bring these mines into production without taking on as much debt. And I think that's where the royalty and streaming companies, the future of the mining industry, especially for gold and silver, is going to be. It's more of a win-win scenario model. I know there's people out there that don't agree with me on that, but you don't have to take on as much debt. So yes, you're giving up a royalty or stream, but it's at much better, more friendly terms than diluting your shareholders with enormous amounts of equity or taking on debt, which could potentially, wipe out the whole company and or bankrupt, everything in the company, wipe out the shares and things like that. So I think the royalty and streaming model, I'm surprised, Kerry, that there's not another couple Silver Wheatons that are smaller than Silver Wheatons. So there used to be a company called I think it was Silverstone, that Silver Wheaton bought about 3 or 4 years ago. Yeah, I'm surprised there's not more of these silver streaming companies that are doing more mining-friendly loans and generating free cash flow. I'm surprised that there's not another couple companies a little bit smaller than Sandstorm Gold doing gold-friendly mining loans and things like that. I think that's what this market really needs in the long term.
Yeah, I think you're right. And yeah, we're just going to have to watch this thing play out because, man, it's just horrible, isn't it?
Well, exactly. And that's the problem with debt, Kerry. So when your assets are not generating the cash flow, you still owe the debt. So that's the problem for your listeners out there. That's why you have to be careful with debt, whether you're running your own business or you're using debt to buy real estate or other types of assets. You have to be very careful with your debt. People in the U.S. have not been taught properly how to deal with debt. We've been conditioned from a young age that, we can consume and use our credit cards and things like that. But you're seeing what happens to the miners when you have too much debt and you don't have the cash flow you thought you did to pay back your debts.
Yep. And there's a lesson in it. These guys are professionals. Even the guys who've been in it for such a long, long time, they've gotten burned. So you need to understand that if it can happen to the professionals, right, it can happen to you.
Yep. Exactly. And that means, don't go all in on any one company. Don't go all in on any one asset class, no matter how good it looks. So there's gurus out there that are saying, you should put all your money in physical metals, or we don't know what the rules are going to be, Kerry. So we don't know. One thing the politicians are really good at is changing all the rules all the time. So the one important rule that I think your listeners should take away from any of their investing or speculating decisions is the one asset class might look much better than the rest right now. Maybe it's gold and silver miners, maybe it's cash flow real estate, maybe it's oil dividend stocks, maybe it's another type of stock on the stock market there. Maybe it's undervalued certain type of technology industry or things like that. But the rules can and will change. The politicians will do or say almost anything they have to stay in power. There has been an enormous amount of extra money printing, Kerry. One of my money manager friends here in the DC metro area, I haven't told you this story before in any of our interviews, but in the last couple months, he's libertarian. He reads Zero Hedge and stuff like that. He snuck into an IMF meeting here in DC, an IMF conference. And he was very quiet, sat in the back, took notes, and there were all the central bankers and technocrats and people from all the major treasury departments of all the world major economies, hardcore Keynesian central planners, PhDs throughout the room. They were talking nothing but currency swaps. Mm-hmm. So they basically admitted in most of the present, they mentioned currency swaps hundreds of times. So there is an enormous amount of liquidity in the system to boost up the general stock market, to boost up the bond market, to boost up real estate prices in the U.S., to make things look a lot better than they really are with the wealth effect and financial repression and things like that. And the currency swaps, Kerry, I think are the majority of the things that have boosted up the markets more than anything else, although there's been, carry trades with the yen and many other currencies, and there's flight capital leaving China and Europe and England.
And on that note, we got to wrap up. So Jason, just tell us where we find you.
Yeah, your listeners can go to our main Wall Street for Main Street website at WALLSTFRMAINST.com, and they can also find me on Twitter at Jason, letter E as in Elliot, and Burack, my last name.
All right. And of course, the link will be found on our site in the show notes to this interview on financialsurvivalnetwork.com. Sign up for our newsletter and the webinar, which was really successful. We had a few hundred people on it. Will be rebroadcast on October 1st at 9 p.m. Eastern Time. And Jason, thanks so much. Talk to you again soon.
Great.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.